Over the past month, my biggest holding dropped about 3.5%. Not from cash, from two words Wall Street keeps repeating: AI fatigue. Investors are getting nervous that all the money pondering into AI centers won't pay off the way everyone hopes. And at the exact same time, the S&P 500 and the NASDAQ both hit record highs, even the Dow. Welcome back to another episode of Almost Wealthy. I'm John. So here's the part that doesn't add up at first. The overall market went up, my single biggest position went down, and it's not some random stock. It's SCHG, the ETF I built my entire collateral strategy around. It pays almost no dividends, about 3.9% right now. So why is this still my largest holding in my portfolio built around borrowing against dividend income? Which is a fair question. And the answer reveals a mistake I think a lot of people make when they build these portfolios. They optimize for income at the expense of one number that actually controls how much they borrow. Let me show you what that means. If you're doing the buy, borrow, die strategy, it needs two things. Number one is a portfolio large enough to borrow against. Number two, enough income from the portfolio to cover interest on what you borrow. Pretty much that's it. Two requirements. And most people who discover the strategy fixate entirely on number two. They go hunting for the highest yield ETFs they can find. Anything with a big distribution number, high yield, low growth, which is pretty much a trap. They build a portfolio that's almost entirely income focused, and then they try to borrow against it, and they run into problems. The portfolio is worth less than it could be because all the growth potential got converted into monthly cash payouts. The income is there, but the collateral isn't compounding fast enough. And in the buy, borrow, die model, collateral is everything. When you take out margin, you're not borrowing against your dividends, you're borrowing against the total value of your portfolio. The number on the screen, what your holdings are worth on a given day. That's your collateral. In M1 Finance, I can borrow up to 50% of my portfolio value. If my portfolio is worth $100,000, I can borrow up to $50,000. If it's worth $200,000, I can borrow up to $100,000. The dividends matter. They cover the interest on the loan, but the size of the loan I can take out, the borrow capacity, the numbers that determines how many bills I can put on margin. That's entirely based on the portfolio value, not the yield, not the income, the value. So if I can borrow $40,000 a year comfortably, I need a portfolio that supports that. Right now, at my target LTV of 12%, a $40,000 annual borrow means I need a portfolio to be worth around $333,000. I can technically do it with much smaller portfolio at 50% LTV, but 50% LTV is dangerous territory. A bad month could put me in a margin call. So I try to stay safe at 12%, which means I need more collateral, a lot more. And to get there faster, I need the holdings that grow my portfolio value the fastest, and that's SCHG. Not because I love tech, not because I want NVIDIA at 11% of my portfolio, because SCHG's job in my portfolio is to make the collateral number grow fast as possible. That's a mental shift most people never make. They think about ETFs in terms of what shows up in the dividend line, not what shows up in the total value. Both numbers matter, but only one of them decides how much you can actually borrow. Here's the mental model I use for everything in the Freedom of Time portfolio. Every ETF has a specific job. Not every holding does the same thing, and they shouldn't. Some are here to grow the collateral, some are here to generate income. I need both. SCHG's job is to grow collateral, appreciate and value over time, make the total portfolio worth more. Give me more to borrow against. SPYI's job is to generate income, pay me distributions every month to cover the margin loan interest, eventually cover the actual bills. GPIQ's job is the same as SPYI, income using NASDAQ 100 options instead of S&P 500. VYMI's job, international dividend income, different companies, different economy, spreading the income sources across the board. SCHD's job, it does a bit of both. It grows faster than pure income ETFs, and it pays growing dividends over time. It's the connector between the two slices. When I look at the portfolio through that lens, every holding makes sense. Nothing is random. It's there because without the collateral job being filled, the whole thing runs slower. A portfolio that's all income and no growth hits the ceiling. The collateral doesn't compound fast enough. The phases take longer to unlock. The borrowing capacity doesn't climb the way it needs to. You need both jobs filled, growth and income. SCHG fills the growth job better than anything else in this portfolio could. I see the opposite mistakes consistently in the comment section. Someone posts their portfolio, it's 100% high yield ETFs. They're proud of the income number, but when you look closer, the collateral is barely growing. They built an income machine, not a growth machine. When you want to accumulate, that's a backwards approach. Say you go all in on income. You put everything into high yield ETFs, SPYI, GPIQ, GEPQ. These things yield 10 to 12% in distribution. That's real money every month. But here's the trade-off that doesn't show up in the yield numbers. These ETFs use covered call strategies. They sell options on the underlying index to generate that income. When the market runs, and it does run, the option caps their upside. If the S&P 500 is up 25% in a year, SPYI doesn't capture all that. The upside got sold off to generate the income you're collecting every month. That's the deal. Income now, growth later. I get why it's tempting. Watching a fat distribution hit your account every month feels good. It feels like progress. But feeling like progress and actually making progress towards the finish line are two different things. One pays you now, the other one builds the thing that lets you eventually stop working. If you're already at the finish line, already at 1 million with full collateral built, that's fine. You've got what you need. You don't need more growth. You need income to cover the borrow. But if you're at 10,000 like I am right now, or 30,000, or 75,000, you need the collateral to compound. You need the total portfolio value to hit the next phase milestone as fast as possible. In a portfolio that's all income, no growth, it gets you there slower. Not a little slower, meaningfully slower, because the collateral is the key that unlocks every phase in this plan. Phase 2 requires a higher portfolio value. Phase 5 requires a higher one still. Phase 10, every bill on margin, requires $145,000. The faster you build that collateral, the faster you unlock these phases. SCHG is the gas pedal. Now let me actually put numbers to this. Say you have $10,000 to invest. You're choosing between SCHG and high yield income ETFs. SCHG has delivered a 10-year annually return of 18.32%. It pays about 0.5% in dividends, almost nothing. A high yield income ETF, let's call it a 10% total return, price appreciation plus all distributions reinvested. Some do better than that, some do worse. 10% is a fair conservative number. After 10 years, 10,000 in SCHG at 18%, it's 52,338. 10,000 in income ETFs at 10% is 25,937, more than double from one 10,000 investment made a decade ago. Now scale that across your full collateral slice. Run it for 15 or 20 years, compounds into something enormous. Now, I want to be fair. The income ETF is paying you real money every month. That 10% total return includes actual cash distribution. In my portfolio, the cash goes towards covering the margin interest and the margin loan. And I need that. The income job is real, but the cash doesn't grow the collateral number the way SCHG price appreciation does. In the accumulation phase, when you're still building, the collateral number is the number that matters the most. Once you're at the finish line, income takes over. But to get to the finish line, you need the collateral to compound. SCHG compounds it faster. That's why it's my biggest position. Now let me address what a lot of people point out in 2026. SCHG underperformed. SCHG was down roughly 10% at one point this year, while dividend ETFs held up better. People noticed, and they asked, does that break the strategy? No. Here's why. My target LTV is 12% right now. At 12% LTV, a 10% drop in my portfolio moves my LTV about 13.3%. The margin call threshold on M1 Finance is 40%. I nearly have 27 percentage points of buffer sitting between me and a forced liquidation. That buffer is the entire reason I target 12% instead of borrowing at 30 to 40% right now. Short-term volatility in SCHG is just noise. The 10-year track record is what I'm betting on. I'm not trading SCHG based on 1 year of tariff volatility. I'm buying more of it every single week. So why this matters to me most right now? My portfolio is at around $10,900 and I've invested $10,358.76. I'm in phase 2 of my buy, borrow, die bill stacking plan, which you can get in the link in the description below by donating. Phase 2 means 2 bills, my phone bill and my internet bill. $203 a month combined will be on my margin loan. At this portfolio size, the annual interest on that loan is less than $150. My dividend income from SPYI, GPIQ, and VYMI cover this easily. I don't need more income right now. What I need is for the portfolio value to climb fast, because phase 3 requires hitting the next portfolio milestone. Phase 4 requires a higher one still. Every phase unlocks when the collateral hits a new number. The faster SCHG grows that number, the faster I can climb to the phases. If I replace SCHG with more income ETFs right now, I'd be collecting more monthly cash I don't actually need yet. And I will be slowly down on the collateral growth, which means phase 3 will take longer. Phase 5 takes longer. Phase 10 takes longer. Every decision compounds in both directions. Swapping SCHG out for yield now would cost me months, maybe years, on my phase progression. So let's fast forward to phase 10, $145,000 portfolio value. Every bill will be on the margin, $3,356 a month. At that point, the income ETFs are the stars of the show. SPYI, GPIQ, VYMI, generating enough distribution to cover the interest on the full loan. SCHG combining growth dividends that give me a buffer against borrowing rate changes. And SCHG still just sitting there appreciating, making the portfolio worth more every year, making the entire structure more stable over time. Then, let's say I hit $1 million, the actual goal. Here's what the math looks like. At a 5.23 blended yield on $1 million is $52,300 in annual dividends. I borrow $40,000 a year, enough to cover my entire annual cost of living. The interest on the $40,000 loan at 5.65% is $2,260 a year. My dividends cover the interest more than 23 times over. I never sell anything. I never trigger a capital gains event. I just borrow, live, and let the portfolio keep compounding. SCHG helped get us to $1 million. And at $1 million, it keeps compounding that collateral while everything else covers the bills. Every phase has its role. And one more thing, in this portfolio is unique. I'm not planning to sell it, not when I hit phase 10, not when I hit $1 million, not ever. This is the die part in the buy, borrow, die. Owning something you never plan to sell. Most investing advice is built around selling. Take profits, rebalance, cash out. This strategy asks you to do the opposite. Hold everything. Let the gains pile up untouched. It goes against every existence you've been taught about investing, but it's the whole point. SCHG holds companies with enormous unrealized gains, Nvidia, Apple, Microsoft, Amazon. If I sell those positions one day, I own capital gains tax on every dollar. If I borrow against them instead, no taxable event. The assets stay in the portfolio. The loan gets paid back over time from dividend income on future borrowing. And if this portfolio gets passed down someday, the heirs inherit it at a fair market value. The cost basis resets to zero on the day of the inheritance. All those years of gains gone from a tax standpoint. And that's the step-up basis. It's the reason DIE is in the name of this strategy. SCHG is the holding that grows the most over time, which means it benefits from the most. Don't sell it, let it compound, let it do its job. So to wrap this up, that's why SCHG is my biggest holding in my portfolio built around dividend income. Not because I'm confused about the strategy, because the strategy has two requirements, and I need both of them to be filled: collateral and income, growth and yield. SCHG fills the growth job. Everything else fills the income job. Take away SCHG and the whole strategy slows down. The phase takes longer, the collateral compounds slower, the finish line gets further away. The question isn't what the highest yield I can find. The question is what grows the number I can borrow against. That shift changes everything about how you build one of these portfolios. If this is how you like to think about investing, please subscribe. I post every week. I'm documenting my whole journey in real time. Phase 2 right now, all the way to phase 10 and beyond. If you want the buy, borrow, die strategy stack and build plan, every phase from 6,000 to 145,000, the link is in the description. It shows you exactly where the milestones are and what unlocks each one. Thank you for watching this video and thank you for your support. See you on the next one.